All right, folks, welcome back. This is the weekend commentary for the ICT mentorship. Last one for May 2021, rolling into June 2021. And as a reminder, I mentioned that we would be doing the daily log entries until June of 2021, and then they would stop. Not that we would completely do away with uploads on a daily basis, but this week we start on Tuesday the lessons in PDF format. So I'll be giving you short little mentorship lessons in PDFs, focusing primarily on the learning side of things, because there's a lot of things I have to cover the rest of this year. So we'll be limiting the commentary about the markets themselves to just the midweek and weekend commentary. Basically what you agreed to when you signed up for the enrollment. The additional things, which is the PDF lessons and things I've been doing on a daily basis, have been just bonuses. So it gets a little bit better now, and some of you will probably want me to continue doing what I've done in the past with charting. That isn't going to happen. We're going to be doing more detailed lessons. So you came here to learn, not have your hand held the entire time. So it's time to roll your sleeves up, time to get busy with understanding the content a little bit more deeply and fleshing out your own unique model. As also a reminder, today's video was delayed because of our holiday. Friends and family are over. I'm just now sitting down to do the video. It's a little bit past noon time, my local time. And tomorrow is Memorial Day, so we will be observing that, both myself and my staff. So there will be no uploads tomorrow, but we will begin the daily lessons in PDF format on Tuesday. I made a post on the news thread on the forum stating that on a normal week it will be on Monday, Tuesday, and Thursday you'll have PDF lessons, and on Wednesday there will not be a PDF lesson because usually in the commentary I'm teaching something on midweek, and on Fridays there won't be any upload because it's redundant for me to do something that I could just simply add on the Sunday commentary. So it allows me at least a day and a half of rest. Gives me an opportunity to ground myself, and I need it. All right, so with that all put aside and delivered to you at your highest point of attention, this is your dollar daily chart. And I mentioned on the midweek review that on this day here, we would have to immediately erase all of this and trade lower. Otherwise, returning back to this bearish order block is not something that we want to see, because if it does that, it's not going to go to that level, hit it, and then react and go lower. Reason why there was multiple taps in here where it had traded to it. So it already moved away from it and broke into an area of sell side liquidity. And that's important, as I mentioned on Wednesday's video, because we changed the state of delivery. We went from a short-term premium relative to this premium right here, and then trading down into this low here, coming back up into it again one more time. That's a short-term premium relative to that dealing range on a lower time frame. The fact that we went to that bearish order block multiple times and then moved lower, trading into the sell side liquidity, that change in the state of delivery is not usually met with a return all the way back up to that same area here to go lower. Now, if this low hadn't traded below this low, in other words, these daily candles hadn't went below here, then it would have been okay for me to anticipate on Wednesday night or Thursday's trading for it to trade up to that order block, then go lower, because we hadn't broken into an area of sell side liquidity. Very, very distinct reasoning, okay, behind all of that. Again, trading below into sell side before going back to the order block, that is not high probability. Usually when you'll see that, it'll trade through it. And I don't really teach that anywhere else in the mentorship, so it's like something I'm touching on now, and you got to see it firsthand outlined before. Now, I stated if we go back to this order block, that's bullish on the short term, because it would take us back up into this imbalance right in here. Now, if you go back and listen to the Wednesday's video, it's always recommended by me for you as a student to watch that video again, or if you have really good note taking, review your notes and the times in the videos where I make specific reference to what I think is most likely going to happen. I say that we were likely to trade back up inside this area about halfway, but I say that we were likely to trade back up inside this area about halfway, but mainly focusing primarily on this candle's high. Now go back and listen to the video. You'll hear me say these things. Trade there, and then we'll see if it wants to trade back down and resume its selling. We have a high to this low here on Tuesday's trading. That takes us right up into optimal trade entry, which also is institutional order flow entry drill with this candle's high. So I blended several things in forecasting on Wednesday. I gave you parameters that we would rather not see, but if we saw them, that being if we trade back to this level, that's not going to be a sell if it touches that. It's going to go through that and touch and go just above this high here. That would be what I would be expecting. That's in the video, folks. On Friday's trading, we trade up into, as you would see later on in that day, just above that short-term high there, which is institutional order flow entry drill as I teach it here, and then a quick rejection. Now I want to see it trade lower. Why did I feel that this was likely to happen and not completely close in or even go halfway in? It could have went up halfway. That's reasonable, but look closely. This low to that high, we have a fair value gap. Wonderful. You understand that. But this low to this candle's high, that's also a fair value gap. When they're right next to each other like this within a specific range, that makes this area a balanced price range. And to add to it even further, we have all of this range here as well. So all through here, we passed multiple times in this area here. So that makes this a very strong balanced price range. And that's what led me to tell you what I told you on Wednesday before it even happened. So it's not a matter of looking at liquidity voids, okay, as Chris Laurie would teach it and people say that I copy off of. It's not that at all. It's understanding price at a greater and deeper level and knowing what the algorithm is going to do before it does it. No one else is doing that. No one else is teaching you that but me. So it's important when I give you these reference points and the logic behind it, because these are specific signatures that repeat, but they have to have the structure and the narrative behind it. Otherwise, you're just guessing at candlesticks. So the logic here of going just to that candle, this would have been more apt to trade to the halfway point here, which is consequent encroachment or complete closure there, if this candle wasn't exposed as a imbalance, so buy side imbalance, sell side inefficiency, and then also this range in here, which is basically a civvy between this candle's high and this candle's low. So in this vicinity, again, that is an area where it's passed through multiple times. So it's not needing to come back up in here to rebalance that as a simple fair value gap. And if you're looking at it just from this candle to here, then yes, it would look like a fair value gap that would probably need to fill. And someone that's been coached or taught my concepts by secondhand nature, rip-offs or resellers, they're going to be telling people this is going to fill, and they don't know what they're talking about. And then you see what it's like coming right from me, where I outline it, goes right to where I say it's going to go, and then react. So it's like walking a dog. Okay, I mean, I know these things like the back of my hand. They're like well-read novels. I know the characters, I know the plot, I know the next chapter's outcome. And while I don't always know to every single day, there are times when it's just so obvious it's likely to do what I think it's going to do. That's when you trade. That's when you look for opportunities. That's when you anticipate things as a high probability condition. Then you don't feel that nervousness. You don't feel that sense of urgency that the trade has to work or else. Okay, it's probably going to work. I have a lot of high odds signatures behind the idea, so therefore I'm going to trust it, put my stop in, risk my management of equity the same as I would in any other condition, and not have any unreasonable expectations about the trade having to be perfect. I just anticipate it panning out. All right, so here is the dollar index hourly chart. You can see the consolidation we were in here and that daily bearish order block. We trade to it right there. And was there any hesitation there? Any stuttering, any kind of pausing? Absolutely not. This is exactly what I said was going to happen on Wednesday if it goes back to that level. So in your notes for order blocks and when order blocks will not be respected, this is where you enter that. You want to show the contrast to when order blocks are likely to be traded to and respected and when they're not going to be respected. This is that signature. If we already have multiple times trading there and we went down and went into new sell side liquidity relative to that dealing range and narrative at the time, trading back to that bearish order block, it's not a high probability short position entry. It's a catalyst to see it run right up into an imbalance or an old high, which it does both here. It goes above this high here, and it goes into that daily high, which is institutional order flow entry drill there. And notice what it does. It trades right through the order block, bam, hits it. Does it spend a lot of time above that level? No. Did it trade much above it? Absolutely not. Then reprices lower. So what I'm saying is other folks outside this mentorship, not knowing these things, would look at this as a random reaction. No idea why it did what it did. It ran up and then rejected. Completely clueless. And there were months at a time where before I learned what I teach you now, I would have that confusion. I wouldn't know what to do, what this information, why did it do that? When I'm telling you this is what it's going to do before it happens. This is actually a good thing. We want to see these types of reactions here, and it gave up the ghost rather quickly, and we're back inside this range. Now we have a little bit of an imbalance in here, and we have the old daily bearish order block. Now this is an instance where it can trade back to that level here, and then it becomes a reclaimed order block because it did what was necessary in terms of clearing liquidity back to an area for institutional order flow entry drill. It dropped quickly. If it rallies back up to that level here and trades into this imbalance, it can go a little bit above and close that to here, but it doesn't need to go back to this bearish order block. It does not need to, but should it do that, that would be acceptable, and it should offer some short-term resistance there as well. And I would expect it to trade lower and attack this sell side liquidity there, and then resume going lower like we were looking for. This is exactly what I was hoping to see. Should we trade to that level? And we got the reaction that we're looking for. So with all those things in the chart and behind us, to me, I'm anticipating the continuation lower on dollar index because we traded up into optimal trade entry relative to this daily chart with this level here. And we had a nice reaction there we wanted to see. It was very quick to give up that premium. So the algorithm went there quickly and then it moved away quickly. Now that to me is not buyers taking it to that level just to run stops as it's taught. That's not what it is. That's the algorithm running up and then rejecting that. Now, as an institutional trader, I would look at that and say, okay, this is one of those things that I'm looking for that indicates that they were probably done on the upside on the near term. So where's the liquidity at now? Here and here. So if we're here or very close to that on Sunday's opening, is this an opportunity? Yeah, but it's to me not worth it because if it trades from this level here, or we open up rather close to this, you could see it return back to this level. So if you try to go short in here, not that I would suggest doing that, but I'm just stating, but from framing a setup stance, if we were trying to enter the market right on Sunday's opening, and again, I don't suggest this, but let's just say for our sake of argument that you wanted to get short right away, not that you should. If you went right in here at the opening on Sunday's opening and say it was relatively unchanged from Friday's close, you'd have to weather a potential run up into here and a little bit more into this fair value gap just to make that run there to take out sell-side liquidity. To me, that's not favorable. I don't even like the idea of it going back to the bearish order block just to get that either, because if it's going to go up here and reject and go lower, it's probably going to go down here. So that to me is a better framework, is going short in this area here and looking for a run below here, and then taking something off below that, and then looking for it to trade to its lower daily low, which is this one here. Okay, so we've already done this run here, and this low is the same thing with here, that low and that higher low. So if it drops and goes into this level here, that's just one objective, a very short-term objective, where if I used the return back to here and it trades below this low, then I would be more aggressive about dropping my stop below the order block. Then it would reduce the risk there. That's the only way I would use that low in reference to where we are at right now with this current market structure and the narrative that I think might be implemented going into trading on Sunday and Monday. All right, dollar index 15-minute time frame. Again, you can see London creates the low of the day initially. We rally up, hits the daily institutional order flow entry drill at a random specific time of day, New York open. So between 7 o'clock in the morning and 10 a.m., the market hits that level, daily institutional order flow entry drill, and runs out the bearish order block on the daily, clears the buy side liquidity here, 10.25. So essentially 25 pips it rallied above the short-term high. You know that signature, I've been teaching it to you. It also trades to a very specific level I called out on Wednesday, and it does so at a specific time of day, New York. And what day of the week was it? It's the last day of the week. So we're looking for the likelihood of this rolling lower. Watch this candle here. It could tap that and act as a bearish order block. I'd like to see it keep this open. That acts like a breakaway gap. And we'll be looking for it to trade back down below that old daily low and then resume attacking that longer term lower low. That's what I'm looking for. That's what I'm anticipating. That's what I want to see the support of in the marketplace on Sunday's trading, in the Monday's overnight London and New York session. All right, so let's take a deeper dive into this. So what elements were present for dollar to reverse right there? Remember, you should have already reviewed Wednesday's video again. It was very, very short. It was less than 8 minutes long. So there's no reason for you not to go and watch it again. In fact, if you haven't watched it, you're going to be better suited to learn from this example by going back and watching it again. But the daily bearish order flow for dollar is the number one catalyst. So we've been bearish on the daily for dollar index. The daily ran out a sell side liquidity pool. The daily dollar index returned to a previous dealing range. And the daily retraced to a bearish order block. So up till now, what I'm suggesting is on that daily chart for dollar, we've been bearish. We'll just speak in very easy terms. The trend has been down on the daily chart for dollar. It rated a short-term low. In other words, it broke an old level of support from a retail trader's mind. So they're thinking it's going to go lower. We were too, but we were anticipating if it returned back to the bearish order block, that would go to this level here and then sell off. Retail would not be expecting that. So it returned back inside of its dealing range between the order block level here and the lower low into the sell side liquidity pool on the daily chart for dollar. That's the specific previous dealing range I'm referring to. So in other words, what I'm saying is this level here and this level here, they are all derived by looking at the daily chart. And it returned back in and traded back up to that level as I outlined on Wednesday. So it retraced all the way back to the bearish order block here, and then daily had a premium sell side imbalance, buy side efficiency above that bearish order block, which is this level here. This is the discount low of that SIBI on the daily chart for dollar index, which I outlined before and called out on Wednesday's video that this would likely be a daily institutional order flow entry drill. So it would go there likely and then sell off. The hourly consolidated right in here, then rallied to institutional order flow entry drill. So we had a little bit of a Judas here and then pumped it straight on up. That's not buyers, that's algorithmic. I proved it to you because I outlined this very thing on Wednesday's video before it happened. So again, what you're saying is, to argue that idea, is it's more plausible for me to be able to read the mind of thousands of traders all around the world in different locations, different cultures, different languages. I was able to read all their minds before they decided to make the trade to buy up here to that level. And then I knew that those sellers would come in at that level and the buyers would sell theirs also. So therefore it would create an imbalance of sellers over buyers, creating this drop down, versus the algorithm is going to run to this level, sell off, and there you got it. Think about it, folks. It takes more faith to believe in all that other stuff than simply just taking the logic at face value that I'm sharing with you here. The low of the day formed at the time I teach you, 2 o'clock to 5 o'clock in the morning, New York time. There's your low. It runs to the high of the day where it makes a market reversal profile. When does that occur? At New York. Well, these are the turning points that I teach you here. That's algorithmic. This is the level. So it's time and price. What do you see here? Consolidation, rallies, smart money reversal, low risk sell, distribution, redistribution, clears the original consolidation. Market maker sell model. The New York market reversal signatures occur on Friday. That's the last trading day of the week, and it's usually going to cap the weekly range. We have that here at a random level, right? No. New York opens post the daily high right in here, and the dollar did not hold the premium very long. In other words, it didn't spend that much time once it traded to that level. That signature is important. The amount of time it stayed there, once it hit there, that is supportive in the idea that we would look for lower prices, because it ran to that level to knock out all the collective buy stops above the short-term highs and daily bearish order block. Daily institutional order flow entry drill comes in like gangbusters and delivery lower as we would expect. Quick rise, quick decline. Now the important thing here, the dollar trades to the daily institutional order flow entry drill right there, the same time that the pound dollar fills in its 60-minute buy side imbalance, sell side inefficiency. Critical measurement of intermarket relationships. So when the dollar goes to where we anticipate it, does the cable market or the fiber market, in other words, does pound dollar or euro dollar, trade to respective discount arrays that leads to a buy for them when this is a sell-off? You'll see as we get to those respective markets. All right, euro dollar, it's our daily chart. Market, as I mentioned on Wednesday, traded up into the last up close candle here, which is a bearish order block, overshooting our fair value gap, which is what we were looking for, running above the buy side liquidity pool. Hits that. I stated that we had right here these lows. That's the next level of liquidity, and if it breaks lower, we could potentially see it trade into this fair value gap, but it would be better if it didn't do that. Did it trade down that far? No. Now think about what's happened here. Euro went lower, but didn't quite get into its discount rate that we were looking for. It did run sell side liquidity, but it did not get down to the deep discount that it could have done relative to what the dollar index did on its upside run to its institutional order flow entry drill on its daily chart. In other words, the level that we saw it run up into on Friday for dollar and then reject that institutional order flow entry drill level should have seen this level traded to here on a relative basis. So in other words, this low here is equivalent to that of the high that was ran on dollar index for institutional order flow entry drill. This should have traded down in an ideal world. It should have went just below that low here and offered institutional order flow entry drill as a buy for euro. But the fact that it didn't do it, to me, indicates near-term bullishness. So this is why I'm, again, electing to say that I want to see it trade higher as a result of that. I don't want to see it now trade into that. And I don't want to see it trade down into the complete closure here at all. That would not be bullish in my mind. It would be nice to see it stay just like this, and also not to see the dollar index rally back up into its institutional order flow entry drill level again. So in other words, we don't want to see that traded back to. The narrative is in motion. If it's valid, it should unfold from what we have in the chart right now. That means that we can open up, not trade back down to this low again or lower. It should just open up. It can come back down a little bit, but then it should resume going higher. That's what's expected by me. And the logic behind it is we did not go into institutional order flow entry drill as a buy here. So what is that? That's a form of SMT, divergence. This did not go as low as the dollar index did, going higher. So where the dollar went higher to a specific premium array, the institutional order flow entry drill relative to its daily chart, we did not get the discount return on euro dollar. So that is like SMT. In other words, it's unwilling to go lower. So there's a cracking correlation there. This should have been met with a lower low run here, whereas we saw in the dollar index make that higher high for its institutional order flow entry drill relative to its daily chart. Now, what I just said, if you're not organized, if you're not really paying attention to what I'm teaching you, if you didn't watch the previous video, if you haven't been paying attention so far in the levels I've called out in this video, referring to what I've already talked about on Wednesday before it happened, all of this is going over your head and it sounds like a whole bunch of mumbo jumbo. Okay, and it's very confusing for you. That is not the case if you've been following along, taking good notes and listening and studying and looking at the charts and digesting it, not just watching it like a Netflix movie, because that right there is going to be the deciding factor of how you find your success going forward. You need to be able to balance these things and refer to the things I'm referring to beforehand, and then after they trade through or away from those levels, come back and study those same levels in respect to what I said is likely to occur and what we don't want to see occur. Because the things that we don't want to see sometimes have conditions that would warrant a opposite idea, or we just simply wait. We don't do anything. So there's a filtering process that I'm teaching you with examples beforehand, so that way you can see the logic of what I'm using in my mind in my decision-making process. So that way you learn from that. It's not me looking at a static chart that's already happened. It's hindsight and saying, this is how you do that, where anybody could come up with a reason or logic to justify why that would be a case to talk about something that's already happened when you have the safety net of hindsight. I did not have the hindsight safety net on Wednesday. I always point to these things and give you the logic of what I'm looking for and why it should do it beforehand. That way you know there is validity, there is accuracy, and there is truth to what I'm suggesting to you goes on. It's not just my conjecture. It's not my fantasy. It's not my made up stuff that like the people outside of the mentorship want to say that it's all made up. There are literally people out there that still think that I'm talking about something that's a myth, that there is no algorithm, that the markets are not controlled, that it's buyers and sellers and supply and demand. It's none of that stuff. And when you see these things for what they really are, it is two things. It's scary because it's like, wow, we really don't have free markets. Right. And we really shouldn't. We shouldn't, because not for these markets specifically, because these are global economic currencies. Like, these are countries' money. This is their money. Do you honestly believe that they would make these markets susceptible to outside interferences that could literally crash them without their control or measure of mitigation? No. That's nonsense. That takes an incredible amount of faith in the unbelievable. But because it's been said so many times for years and years and years that buyers and sellers are what push markets around, if you say a lie long enough and loud enough, eventually it'll be accepted. And that is pretty much what they've done. They have brainwashed every retail trader to think that the markets are random, when clearly I have shown you for years now, even before I opened this mentorship up, that these are not random markets. But now, because you're here and you're in my house and I'm showing you things that I won't make public, like on YouTube or anything like that, I'm showing you the things that you aren't supposed to know. You aren't supposed to know these things. And I'm illustrating them before they happen to prove to you I know what I'm talking about. So it's not a magic trick. It's not some other logic that I'm leaning on. It is my understanding of the programming that the algorithm uses. That's it. So if you understand these things, it gives you an incredible edge over everyone else. It's not perfect, because there's times when I'm not going to see or be able to perceive what the market's likely to do right then, because of the timing aspect of our meetings, which is midweek and on the weekend. So I've put myself in a box where I have to tell you what I think is going to occur before the market opens up, like I'm doing here. The markets are not trading. You'll have this video by 4 o'clock or so before the markets open up on Sunday. I'm recording it right now, Sunday, the 30th of 2021. And as a matter of fact, the time is 1:12 p.m. Okay, so it's 1:12 p.m. So everything I'm telling you right now, is before the fact. Just like it was when I was doing the recording on Wednesday, when that recording made its way to the forum. Once I make those videos public in the mentorship, they aren't edited. If there's any mistakes, if I say something wrong, it is what it is. And I don't go back in to save face or anything like that. So it's important for you to know that I'm walking out here on a high wire every week. Even though I'm not doing live trades in front of you, even though I'm not giving you entries, stops, and targets, even though I'm not doing a MyFX book, even though I'm not opening up, all of my previous years as a trader, showing you every time I've done this and done that, what I'm doing is even harder, because what I'm basically saying to you is, trust me on the basis of what I'm going to tell you is going to happen next. Now, you know the value of that because you still stay here. That's the type of student that I have been looking for all this time. I don't want the person with their hand held out. Help me, I'm coming from a poor nation. Help me, I'm coming from a poor background. Help me that I have a job and I have children and I don't have a whole lot of time to study this stuff. Help me do this trading, give me setups. Make me your one-on-one type student. That's not the student I'm looking for. And it sounds insensitive. It sounds like I don't care. It sounds like I'm arrogant and ignorant and I'm only concerned about myself and I don't really want to teach people. That's not what this is. I've learned that the proper student mindset is the individuals that know, number one, the value that's laid before you. Two, is willing to do 90% of the work. I'm going to point, but I'm going to show you things that repeat. You know what to look for if you're looking to be a buyer, and you know what to look for if you're looking to be a seller. I'm giving you the narratives. I'm giving you the logic that leads to the likely outcome over the next coming days and what the weekly range might want to do. So to me, if I was being honest with you, and obviously I'm referring to myself, so give me a little bit of latitude here. If I was where you are right now in your learning and I didn't know what I know, and someone was able to do what I'm doing with you as a group, showing the logic of why it should do these things, I would literally be in heaven, because I was many times doubting anyone out there. And at times I thought that Larry Williams got lucky, that's why he only did it one time in the World Cup, because if you can do that, then he should have been able to do it more than one time. And now think about what that logic is. That's the same thing that's going to happen when I win that. He ain't going to be able to do it again. All these years he's probably been failing, and now he does it one time, he wins. So it's a fluke. A broken clock's right twice a day. that logic. And I had that toxic thinking too. And I was not learning anything at that time. And I was losing money. I was a young man, frustrated. But if I was sitting in an area where a person keeps coming back, that's consistently saying what's likely to occur, I would not care if this person was telling me when to buy or sell, because he's telling me, or she's telling me, because it wouldn't make a difference, because I learned from Linda Resch, and gender didn't have any basis on whether or not I felt the teacher was going to be appropriate or capable. But if anyone would have been doing what I'm showing you for not just a week, not for a month, for years now, I've been doing this for years. So it's not a patting of my shoulder saying you're doing good, ICT. I'm just pushing a little push pin in as a mile marker for you. You have now witnessed me doing these things. No one can take that from you. No one can change history. No one can say you did not see it firsthand. They have not been able to expose me in the past. They're never going to be able to expose me as anything except for what I say I am. You are in a unique place in history, not because of me, but because of the gift that I've been given that I'm sharing with you. Don't blow it. Don't waste it. Don't squander it. Don't abuse it. Moving on to the Euro hourly chart. All right, so on Wednesday, I said that we would likely see it trade up here. If it did, we would attack the sell side liquidity here. And on the higher time frame hourly chart, we had sell side liquidity there that was likely to get traded to. And if it did that, it would put the near-term bullishness on the back burner for a time period. The last three down close candles, which is your bullish order block, that's what's being shaded here. And the level here is just the old low. And this is also the imbalance on that daily chart. Again, the imbalance is here. And that's these two levels here. This is the premium high, discount low of that fair value gap on the daily chart. And this is the order block. Look at the bodies of the candles respecting that. See the close of that candle here and the open of that candle. It's right there on the open of that candle. So all the bodies start with that candle's open. That's algorithmic. That's not demand. Okay, that's not what that is. That's not even a fresh zone because it already traded to it here. So, sorry Sam lovers, that's not what this is. This is the order block, and it trades down right below these relative equal lows. So it runs through that after going into this level here. Again, go back and listen to my commentary on Eurodollar, and you'll see me say if we go higher and goes into this area here, it's going to attack this liquidity there. And you already knew on the hourly chart and on the daily chart that liquidity for sell side was resting below these relative equal lows. And if it got excited, it would trade down into that. The fact that it did not trade to that level right there, that's what I'm making a case for. That's what I'm suggesting is important at this moment. When the markets are closed, this reaction here is important because we did not go to that level or just below that low. That would be institutional order flow entry drill on Euro, which is a mirror image and event that was seen in the dollar index when it went to its institutional order flow entry drill sell. It did not see the same thing happen in reverse on Euro. That's the SMT divergence. So it's not always looking at like high to lower high, whereas the dollar would have made a low and lower low. This would be a divergence from an SMT standpoint, where the Euro should have made a higher high when the dollar made a lower low. That's your classic SMT. There's other ways to use SMT, which is what I'm teaching you here, that it went to a level that is still a discount, but it didn't match the same discount array that would be seen in that premium array on the dollar index. So there's that imbalance between arrays, not just lower lows and higher highs being equal or a cracking correlation that I've been teaching SMT even on my YouTube channel, which is public. I don't mind that being out there. That's basic stuff. This, to me, is a little bit more significant, and I won't talk about those things on YouTube. And I know some of you in here are running YouTube channels and you're doing your own little thing, teaching stuff on YouTube. And yes, it irritates me. And yes, it's disrespectful. But you're also the reason why I've knocked off a lot of things that I wanted to teach when I first started doing all this mentorship in 2016. So you're the reason why. Euro dollar 15-minute time frame on Forex. This is that same imbalance I stated that we would see. If it traded up into that, Wednesday's commentary, if we traded up into that, then we would trade lower. And this is that order block that was outlined on the hourly chart. And the turning point at New York and the high formed initially in London. But all of this consolidation in here, that is that distortion of time. Strip it down to its dealing ranges. We had this high here, trading down to this low. Then it returns back up into that imbalance between the discount low and the premium high, which is that fair value gap on the hourly chart. Trades up into that, and more specifically, look closely in between that level here and here, you have this fair value gap there. So from a fractal standpoint, the imbalances are fractal as well. So just like an optimal trade entry is fractal, you can find a smaller optimal trade entry inside of a larger, inside of a larger, inside of a larger fractal. The imbalance can be reduced down to a smaller imbalance, which is the purest form of imbalance that needs to be retraded to. So this low to this high that's shaded in pink, well, it's really red, but because it's shaded differently or lighter, it looks a little bit pink to me. But it trades back up into that level here. That's the real rebalance. At that moment right there, the market can start going lower. That's the true turning point there. So we have high, low, turning point. All of this is distortion by time. Even the run below here, it returns back inside the range from this high to that low. This is why charts are not the answer. This is another reason why I also state that what I'm trading is outside of the chart. See, you all are forced to look at these candles. And if I'm showing these charts like this, then I'm forced to refer to it or outside of it. And what do I mean by that? The range high and the range low here, and then returns back to the sell setup, that's this imbalance here, all framed and outlined beforehand in Wednesday's video. Now, I didn't call attention to this one in here, specifically say sell it there, but I did say that if we trade up into that imbalance, then it would go down, then it would run the sell side liquidity below. Go back and listen to the video, okay? I'm not making it up. But that range from here to here, that's your dealing range. What is it? What do you mean by that, Michael? Well, this high here to that low sets the initial range. So this is your initial range. Then your dealing range is from that low where it trades back up into the previous range, high and low. It's just dealing inside of the low and the high, knowing that it's not likely to return back to this high. We outlined together as a community, me specifically, Wednesday, that this would likely be traded into. And if it did, then we would see lower prices. So we know going back up in between this gray line and this gray line, if it goes there, that's a setup that's bearish. To refine for entry purposes, you look inside the lower time frame, 15-minute time frame, you can see that imbalance there. So when it hits that, that is an area where you can anticipate getting short, or where the algorithm will turn price and keep it at bay. In other words, try not to send it higher. Well, you can see that happening here. But because of the time element the algorithm is on, it stays in a range where it's not doing anything. It's not going higher than that high. It's not going lower than the lower low that it made here. So the dealing range is this low and this high. It's staying inside of that high and that low all through here until we trade there. So when it breaks down, what's occurring? Traders are getting caught short or stopped out on longs. They're selling the breakout below that low. And then what happens? The algorithm does what it does on London. It creates a Judas swing. It goes above a short-term high. But the only thing that's occurring, it's returning back into this range high and this range low. strip all of this consolidation out. Cut all that out. In other words, do a screen capture of this chart as it is right here, okay, on your platform, because there's watermarks on your chart in this video. But basically make your chart look like this one here, and then do a screenshot and then paste it in like MS Paint on your computer, and then cut all of this from midnight, cut all that out all the way up until like right on here. So this big down close candle right there, keep that one there, and then match up this candle as the next candle right there, and look at it that way. I could do it for you, but it's important for you to do it yourself. And some of you probably aren't going to understand what I'm going to do here, but I'll share it with you on the teaching I'll do on Tuesday. I'll just include it as an additional slide. But you'll see having all this information here removed, okay? Just remove it out of your chart and then paste with this whole area here, cut that out and slide it over and put it right next to that candle right there. And you'll see what the algorithm was really working with. And this was just distortion by time, because these candles are 15-minute intervals. It doesn't matter what the algorithm's sending it higher or lower. It's only going to be marking time. That's all it's doing. So that's why charts are not the answer. And that's why I laugh at retail traders with their patterns and all these BART patterns and all these shark patterns and harmonic this and this. And it's nonsense. That is absolute nonsense. The algorithm has no idea about a harmonic pattern. It has no idea about your Fibonacci ratio trades. It has nothing to do with animal patterns. It has nothing to do with supply and demand zones. It has nothing to do with Elliott wave. It has nothing to do with any of that. It's dealing in specific areas for liquidity purposes, rebalancing, all on the basis of time and price. But the one creates the high of the day here, sells off, trades down into the market reversal profile on New York, hitting the order block, and then rallying back up, taking out the buy side. Liquidity resting above here. Retrace back down into this small little imbalance here. I like that. I like to see it continue higher. We have buy side liquidity here, and we have a pull liquidity rate above these relative equal highs as well. So watch that. Now, if it does need to retrace a little bit deeper, it can go into this area here. I don't think it needs to come back down here. If it comes back down here, I'm absolutely wrong, and there's nothing wrong with that. But everything I'm outlining here is based on what I've fleshed out here for you relative to Wednesday's commentary and then Thursday and Friday's trading. All right, British pound versus US dollar daily chart. You can see the old daily high we're looking for. I mentioned on Wednesday that we would see this area here for sell side be likely to be taken out next, and nothing in here looked terribly exciting, as I mentioned. So this is the draw on liquidity. We traded down into that there, and then completely rejected that immediately. Came back down into this level here, which is the bullish order block. These two levels here are going to be different color when I go down to the hourly chart and 15-minute time frame. I'm going to make this level here red because it's running out on sell stops, and I'm going to make this line here blue, and I'm going to make them thicker so that there's your reference points for the institutional order flow that's being worked with here. I anticipate the market's going to trade above this high. This level here is a weekly high. Okay, so I'm not going to show you the weekly chart, but it's a weekly range high that I think is likely to be drawn to over time. How much time, I don't know that, but I think that the next run above this high here will set the stage for that there. All right, here's that level I said on the daily chart that I would make blue. That's the bullish order block, and this is that red line here where we went down below those relative equal lows where the sell stops were. And I said that's where it's likely to go to, and anything below that didn't make any sense, but there you go. We traded down into it, cleared the sell side out, and then rallied aggressively above the down close candle here on the 26th, and the order block level is here, so that's the candles opening on the daily chart. Then we created this buy side imbalance, sell side inefficiency here. So this candle's high, this candle's low. The market trades above the short-term high here, and then comes right back down into this imbalance. So it's doing two things here, folks. Listen, it's coming back into this dealing range, It's trading back down into rebalancing this buy side unbalanced, sell side inefficiency, and returning into the daily bullish order block. So we're doing several things here, and then we get the reaction. This occurs exactly at the same time when the dollar index made its high at the institutional order flow entry drill level I outlined on Wednesday. This is that buy side unbalanced, sell side inefficiency on the hourly chart, and the green line is anchored here and the green line is anchored there. We're extending it out in time. So that's your range. The order block level is here. So inside this little square, that's the area of opportunity. What opportunity exists in there? Well, there's several things you can do. You can buy at the complete closure of that imbalance with the expectation it will probably make a run above these relative equal highs. I know that doesn't look that relative because this one looks a whole lot lower there, but when you're zoomed out, they're relative equal highs. That's how I define it. And it's a lower high to the right than that of the one on the left. So you know that's a likely low resistance liquidity run signature. Inside of this square, it is the range, okay, relative to the buy side imbalance, sell side inefficiency, and the order block there. Now look closely. You have the low, it rallies and trades right back down into the order block level, and that is optimal trade entry. So if you look at a 5-minute chart, this is a classic optimal trade entry in here. And if you use the range 8:30 in the morning until 11 o'clock as I teach on YouTube, which is not this specific, these are the actual turning points. That's these kill zones give you, okay? So in your notes for kill zones, the 7 o'clock in the morning to 10 o'clock in the morning, New York, which is down here. I'm sorry if I was looking here. The 7 o'clock in the morning to 10 o'clock in the morning, New York open kill zone. That's going to be your turning point, high or low, for that session. The 2 o'clock in the morning to 5 a.m. New York time is the London Open. That's going to be your turning point, high or low. Your optimal trade entry can occur from the London into the New York Open kill zone window. It's not always going to be just inside this little window, okay? The idea also is further communicated by saying like this old high here, and we have this low there. This turning point is an optimal trade entry relative to this range high and this range low and this dealing range here. Gives us a run into London Open. That's your optimal trade entry, and it sells off, goes down to a level of rebalance there, order block. But then we have a potential turning point again in New York. But at that turning point, even though at 10 o'clock in the morning, is that 11 o'clock? No. You still have an hour's worth of trading potential where the setup still can form. The turning points form at these times: 2 to 5 a.m. London, 7 to 10 a.m. New York. That's what I've been teaching you with these daily log entries and why it's no longer necessary. You have now a log of weeks and months that you can graphically go back and see where these kill zones call the turning points, just from a time standpoint. Then you have to look at the price, time and price. So is this price significant at this time? Yes, because we have this low and this high. So that's an optimal trade entry sell right there. Well, the same thing is occurring here. We have the turning point in New York Open between 7 o'clock and 10 o'clock in the morning on Friday. It creates a turning point there and rallies up and then trades down lower here. This is an optimal trade entry. So this is a nice buy to see it run back up into all of this range from high to low. If you use the 79% retracement level, that would be a nice little day trade. It doesn't need to take out the buy stops. It doesn't need to trade back over to here. And you don't need to hold through the weekend, where all of what I'm saying here could end up becoming a washout. This could end up just going right back down and clearing all this out, and none of it made any sense holding it over the weekend. That's why I don't personally hold over the weekend anymore. But this is, again, the turning point relative to the kill zone. Now, optimal trade entries is just to bring in another element to it and then close this video out. I recently gave a 3-part series on, I'm going to close it at 3 parts on the YouTube channel. I thought about doing another addition to it, but I'm done. But the if I was 20 years old, how I would go back in and do it again, all over again. I give a very specific rule-based idea of how to use an hourly chart and simplify it. If we have an old high rated and it trades above it, I would look for a potential optimal trade entry sell. And I don't need to make a lot of pips. That's what's occurring with this low right there. It trades down below it there. Strip all of the buy side imbalance, sell side inefficiency out. Strip this order block level out. Just look at the turning point. London to New York. Did it trade down below an old low? Yes. Once it does that, then simply wait and see if it offers a potential optimal trade entry buy. Bam. It only needs to trade back above this high for 20 pips or thereabout. And it doesn't need to do any of that. That's a trade, folks. That is a bread and butter setup. That is a quit my job setup. That is, I don't need to worry about 50R, 20R, 80R, 100R, 200R, 10R trades. You don't need that. You don't need that stuff, folks. You just need to find a way to find something that repeats over and over and over again. And should that occur, you go in and you engage with it with very low risk. And if you develop a skill set around that idea, you'll have it. You don't need to know the weekly range high and low. You don't need to know what the daily bias is every single day. All you need to know is on an hourly basis, does it take out a low or does it take out a high? And then after it does that, does it frame a potential optimal trade entry reversing? That's it. And you don't need it to run all the way back up to where the previous high was. In other words, we see this optimal trade entry form. Everyone's going to think, okay, take it all the way up to here because that's greed. You don't need that. This pattern can just trade right above this short-term high here, and that many times can be it, and it could just roll over and go the other way. But if you bought in here and you take 20 pips out just above this short-term high at 70, what's wrong with that? That's 20 pips. That's a bread and butter setup. If you find that a couple times a week, you're done. If you know how to find these setups and you do 2% risk and you set it up in such a way where you're able to do 2% per week risk in 1-to-1 basis, that's 8% a month. That's more than doubling your equity every single year. That's wealth creation. It doesn't force you to trade a lot. You have a whole lot of lifetime to do whatever you want on a day-by-day basis, and you're not living in front of these charts. So it's however you want to make this. I'm giving you that freedom. I'm not forcing you into a box where it says, do this, this, and your result's going to be that. And that's how you know you made it. Because that's not logical. That's not realistic. And nobody teaches that. Nobody gives the same results to every student. There isn't one. There isn't a mentor. Nobody does that. Nobody does that. And that's the kind of crap you see on YouTube ads, Facebook ads, Instagrammers. Oh yeah, all my traders get the same cookie cutter results. No, they don't. Because if they did, they would be proving that. And they don't. It's just verbiage. It's just talk. It's lies. And I want you to know how to do this truthfully, realistically, and the least effort possible. But I offer you freaky levels of precision that you can grow into. But I also remind you that it's going to take you decades to get that good. Not 2 months, 6 months, a year, 18 months, 2 years. It's going to take you decades because there's a lot of things that you have to learn about yourself, and you're not going to trust until you see that long of time behind you where it's worked and you've been seeing it.